We've been in a pretty good market lately. The market's been pretty much going up, up, and up. But what if it goes the other way? That's what they call sequence of return risk. Sequence of return risk is, hey, if the market goes down, am I in trouble? And it's why a downturn in the first year of retirement can cause lasting damage. Many savers believe that retirement success comes down to market returns, but the big thing is when market moves, it can actually matter more. And that's called sequence of returns. So think of it this way. Market's heading down and you're taking money out of those accounts. So as you're taking money out of those accounts, you're accelerating the downward movement of your accounts. So your account's going down a lot more. On top of it, if you couple it with taxes too, if you're pulling money out of an IRA, you're also paying taxes. So it's compounding. It's moving it quicker down on you. And so let's say you go and you retire and you retire during a period of time when the market is going down on you. You might not have enough money to get through retirement because you're kind of beating up the account is how I want to word it, because you're paying taxes and pulling money out of it. So what do? Do you just cut back and not spend? Why'd you retire? You want to get through retirement and enjoy retirement. That's why you did it after all. It is a big risk that people are worried about. In fact, a lot of advisors worried about it too, because when they build out projections, sometimes those projections doesn't work if we're in a down market. So you got to build protections into it. Why the first year is considered a danger zone for investors. One of the things that I'm going to tell you, a lot of times when we're building plans, we want to bake some extra in because that's how you protect against a bad first year. This way, if we have a bad first year, then you're still okay in retirement. But the thing is, danger zone, if you kind of save just enough for retirement and you go through the first year as a bad year, the second year is a bad year, then you might rerun a projection. And instead of someone having enough money to get out into their 90s, which is kind of what you want to do, they might only have enough money to get to 85. So then what happens? You might have to go back to work. You might have to change lifestyle. That's why it's really important to build a plan also, because if you get a retirement plan ahead of time put together, not only do you want to plan on how you're going to draw the money, but also allocation. How do you protect what you have? How do you make it so that you can go through good and bad markets? Early losses can still cause permanent damage. And that's pretty much what I mean by, hey, you might not have enough money to make it out to 90. The damage is already done. So we've been in such a hot market lately. One of the biggest things that's going on, I have people come in, visit with us. They're all on risk. And what I mean by that, they're taking chances. They're buying into tech stocks. They're buying into things that are growth based. And let's say they're 64 and they're going to retire at 65. If they're 100% growth, thinking that the market's never going to fail, and then when they turn 65 and they're ready to retire and the market does fail, growth stocks typically drop the most. If you take a big hit, and this happened in 2008. I remember back then hearing from people, they were invested, all risk. The market took a big hit in 2008. I think it was about 52%. Certain people that thought they were aggressive investors kept the money in cash after that. They were scared after. They never brought the money back into the market. They had big changes going through their retirement. So you got to build a balance plan. You don't want to be that person that, hey, the market falls apart, you're retired, and now you're sitting home just eating peanut butter and jelly. Although peanut butter and jelly is good, I eat it quite a bit because I like it, but you don't want to be forced to have to make decisions like that. You don't want to be forced to take a reverse mortgage on your house. You want to go through retirement comfortable. What happens when retirees have to withdraw during a downturn? I can tell you that if you don't make any changes, you're making things worse. Remember, market going down, you're accelerating the downward movement on your account because you're taking money out, paying taxes. What we do at Tumolo Financial is typically we build a backup. And the reason we build a backup is so that when you're going through retirement, if the market starts to fail, you stop drawing out of the market money. This way, the market money can be left alone and it can recover. You're not making matters worse drawing from there. And we've built some safer investments that didn't go down. So you're drawing from those safe investments. Think of it this way. Back when you were working, you were drawing a paycheck. So if the market went down, it was actually kind of a good thing because you're contributing into your 401k during that time and accelerating growth for when the market does recover, buying low at that point. But when you're in retirement, you're kind of selling low at that point if you need to take money out of the market. So what you want to do is protect yourself against that, make it so that no matter what, you keep doing what you want to do. Fear and emotions can make it worse. Self-investing, do-it-yourselfers, some of them are very good at what they do. And some of us try to do it ourselves. And unfortunately, some of us, when we try to do it ourselves, we're trying to build certain things into it because, if the market goes down, it's going to do this. It's going to just we'll say a stop loss. It's going to sell all my investments. Sometimes that works in a bad way for a person. It sells at a point, the market bounces back, and then the person lost out on the recovery. You think you're doing something to protect, but it's actually, you might be making things worse. I'll use that example again. COVID, market going down, and then fear and emotion kicks in. I want to sell everything that I have, and I don't want to be invested in the market anymore. And then they leave it out even during the recovery, so their money never recovers. So the market's going to do what the market's going to do. You never know if it's going to go up. The market goes up when it's going to go up. It doesn't go up every single day. So the thing is, you kind of have to be in it to get through retirement these days, but you have to balance your risk level. You have to make it work for you in retirement. So have a strategy for income so you're not forced to sell during the downturn. Create a flexible withdrawal strategy. Be able to draw from someplace else in the bad times. This way you don't stop doing what you're doing. And last one, and we hope that you don't have to do this, but some of us may have to adjust our spending in down market years. But if you build a plan and dig in first, you're trying to prevent that. So for many of you, market risk is not just about how it performs, it's when it performs. If you want help building a plan that weathers the volatility of the market, visit us on our website at tfcheckup.com or click on the link below.